Welcome back. Today we are discussing how to qualify for the 20% business income deduction if you are a real estate professional or own rental property. For real estate professional, qualifications under the old rules were unclear, and rental property did not meet the definition of trade or business to qualify for the 20% qualified business income deduction under Internal Revenue Code Section 199A. Uncertainties, the Internal Revenue Services issued final regulations in mid-January of 2019. These regulations clarify that all real estate agents and brokers who are not employees but operate as sole proprietorships or owners of partnerships, S corporations, or limited liability company qualify for the 20% business income deduction. The deduction will generally apply for taxpayers with taxable income at or below $315,000 for joint filers and $157,000 for all others. Those with income above these levels are still eligible for the deduction, but are subject to limitations of IRC Section 199A. I have a separate webinar going over those limitations, so go check it out if you haven't already. Final regulations also introduced a safe harbor election for owners of rental properties. Like I have already mentioned, rental properties did not qualify for the definition of trade or business under IRC Section 199A and therefore were ineligible for the 20% QBI deduction. The new safe harbor election simplifies the process that owners of rental real estate enterprise, we will go over what that means in a second, must follow to claim the QBI deduction. To qualify for treatment as a trade or business under this safe harbor, the rental real estate enterprise must satisfy the requirements of the proposed regulations. So, a real estate enterprise solely for the purposes of this safe harbor is an interest in real property that is held for production of rents and may consist of interest in multiple properties. To qualify for the safe harbor, the following requirements must be met. I will put them up on the screen so that you can screenshot them and save them for referencing later. Separate books and records must be kept for each rental showing rental income and expenses. The taxpayers must also maintain records, including time reports, logs, or similar documents regarding the following: hours of service performed, description of all services performed, dates on which such services were performed, and who performed the services. Such records are to be made available for inspection at the request of the IRS. This record requirement will not apply to taxable years beginning prior to January 1st, 2019. And the second requirement is the rental service requirement. For tax years beginning prior to January 1st, 2023, 250 or more hours of rental services must be performed per year. For taxable years beginning after December 31, 2022, in any 3 out of 5 consecutive taxable years that end with the taxable year, or in each year for the enterprise held for less than 5 years, 150 or more hours of rental services must be performed. What qualifies as rental services? Advertising to rent or lease to real estate, negotiating and executing leases, verifying information contained in prospective tenant applications, collection of rent, daily operations, maintenance and repair of the property, management of the real estate, purchase of materials, and supervision of employees and independent contractors. The term rental services does not include financial or investment management activities, such as arranging financings, procuring property, studying and reviewing financial statements, or reports on operations, planning, managing, or constructing long-term capital improvements, or hours spent traveling to and from the real estate. What rentals do not qualify? Real estate used by the taxpayer as a residence for any part of the year, or real estate rented or leased under a triple net lease is also not eligible for this safe harbor. And most importantly, taxpayers must remember to include a signed statement in their return on which they claim the qualified business income deduction. That is all I have for today. As always, there is more information and sources linked in the article below, so go check them out. And if you found this webinar helpful, give this video a like or let me know in the comments below. Until next time.